Financial Planner. Follow us on YouTube.
The central banks position themselves to transition the world into their new system. Let's get into the economic collapse financial news. Now, we can see the corporate media, they are out there, and MasterCard, released their press release on how much people have spent over this holiday season, and we're going to get into that in just a moment. But what's very interesting is that consumer confidence pretty much stumbles as hope plunges. And what we're seeing is there's this huge spread. Now, the spread that we're seeing, this is the widest spread between current and future expectations in history. And every time we've seen this type of spread, what has happened? Well, if we go back to 2008, we saw the same thing, where the current and future expectations, there was a huge spread, and basically we entered a recession. If we go back to 2001, we see the same thing. If we go back in time, it's pretty much the same thing. And here we are once again with that same exact spread. And this is just another indicator letting us know that something isn't right. Now, we know the retail industry, they've been struggling. A lot of stores are closing. And the corporate media is out there telling us that this is one of the best holiday seasons that we've seen in a long time. And MasterCard, they released their press release with some data on how much, remember, debt people have used to purchase items. Now, this press release came from MasterCard Spending Plus, and it reported the holiday shopping, and it didn't include automotive, and it didn't include gasoline sales. So from November 1st through December 24th, across all payment types, cash, check, and everything else, we see that they're saying that retail, or spending I should say, rose to 4.9% from the same period a year ago. Now, it makes it seem like it moved up another 4.9% and it's doing great. That's not what happened. If you go back a year ago, 2016, the spending at that time was 4%. So we went up 0.9%. That part is a little misleading. Now remember, we were at 4.9% and 4% back in 2016, and stores were closing. They couldn't make it. Here we are at 4.9%. And again, this is what people spent using debt. This is not the profits of the stores. These are two different things, because what's included in this is people going out to dinner, people buying a lot of food for the holidays, Thanksgiving, Christmas, and everything else. This is everyday shopping. This is not just one thing. So this is a lot of different things all wrapped up to one, and a lot of people use their credit cards to pay their bills. So we need to look at this very, very carefully. And if we go back to 2016, like I said, retail sales grew at 4% in 2016. This is coming from the same type of press release that MasterCard Spending Pulse puts out there. If we go back to 2015, they released the same numbers, and it was 7.9% in 2015. In 2014, it was 5.5%. So we went from 5.5%, and all of a sudden we went to 7.9%, which means nothing. This is just debt. And then all of a sudden it dropped to 4%, and we're at 4.9%. So where have we really gone? Is this really that great of a holiday season? Because we're hovering around that 4%. Now, let's go a little bit further here. Online sales went up to 18% year over year. Now, they're making it seem like, oh my God, it's at 18%. But it was at 15.6% last year. So it wasn't like it doubled, it tripled, or anything like that. More people decided, I'm going to sit at home and I'm going to order online. No, this is not all Amazon. So we need to look at this data and we need to say, well, wait a minute. What are they really doing here? What really makes sense? Now, what's very interesting is that if you remove the gasoline sales from their number, 4.9%, sales went up by 4.2%. Is it as great as they're saying right now? No, it's not. So what is happening here is they're using 4.9% to make everyone believe that sales increased by 4.9%. Sales didn't increase. Debt increased. We don't know what the holiday season is going to look like until the retailers publish their numbers. And what profit, and that's the bottom line, what's their revenue? Because, yeah, this is a great number, 4.9%. Well, it really isn't, but 4.9%. But if they didn't make any profit, they're going to be closing down. And if we look at this, we could see that there's major problems here. Now, coming out of Optoro, they look at the holiday season and they say, okay, we see the holiday season and we're going to give you an estimate of the returns. They're saying that consumers are going to be returning about 45% of their purchases. And it's going to be about 90 billion worth of goods. So we're going to have to subtract that number when the returns start coming in. And most of the returns, guess what? They end up in landfills. A lot of it, they don't even restock on the shelves. They go back to the manufacturers. It might be damaged, something else might be wrong. And we can see right now, this is going to be a problem. Now, UPS is out there, and they're saying that they're looking at a huge return extravaganza in January of 2018. They said, listen, last January 2017, 5.8 million packages were returned to retailers. And they're saying that in January, they're going to probably beat that number. Now, when we look at all this, and even when we go towards restaurants, we can see that restaurant sales, they are down. Now, look at these numbers. They were at 5.6% in 2016. They are on pace, and we're almost at the end of this year, for 3.2%. That's how far restaurant sales are down, which tells you we are in a whole heap of trouble. Now remember, a lot of these purchases, they are done on debt. And we can take a look at these debt levels because the Urban Institute was able to release figures on debt levels across America. And when we look at the states, we can see that, wow, a lot of these states, the people that live in these states, there's a huge amount of debt. And we see right now, Statista reports nationwide 33% of people have debt that has gone into collections, which means they have unpaid billed creditors, have either closed or are trying to collect. Now in Louisiana, we see that there's about 46% of the population in Louisiana who are in debt. 44% in Texas, 43% in South Carolina, which I mean when I say they're in debt, this is debt in collections. West Virginia, 42%, Nevada, 41%, Alabama, 40%, Georgia, 40%, Kentucky, 40%, Mississippi, 40%, New Mexico, 40%. We are a debtor nation. And we're going to see a lot of these numbers, they're going to be revised. And we're going to get the real information when the retailers start to produce their real profit, revenue, sales numbers. But we can see right now there is a 2018 death watch of certain retailers. Claire's stores, well, it looks like they are on a death watch. They're seeing that sales, they aren't doing too well, and they're very nervous about this holiday season. Charlotte Russe, they are very nervous about, what is going to happen this holiday season, and they might be closing stores. Bon-Ton stores, the same thing happening with them. Buy Low, Barnes & Noble, they're looking at this holiday season saying they don't know if they're going to be able to make it. They might have to start closing some stores. We see that 9 West, we know that they declared bankruptcy in 2017, and it looks like they might be closing a lot more stores. GNC was actually doing well, and then all of a sudden, they are on the death watch now, saying that, sales are dropping right now, and we might be closing some stores. And there's going to be a lot more stores that are going to come out and say, we're having problems here. And as we move forward, I think things are just going to get worse and worse. And I think these numbers that they're putting out there is trying to convince everyone that this holiday season was one of the best we've ever seen. Of course, they said, this is one of the best since 2011. Well, 2011 we were coming in a recession. I mean, just go back a couple of years. This number that we have right now is absolutely awful. This is not a good retail number. And again, once the retailers come out and they tell us what the real information is, we're going to see that, yeah, this store's not doing well. We already have restaurants like Subway already saying they're closing stores. We're going to have stores that are just not going to be able to make it. And with this 4.9% debt number that MasterCard is throwing out there, it doesn't look that good, even though the corporate media is trying to make it seem like it's incredible. Now, what's very interesting is that the Fed is out there, and we mentioned this many times before, where they're saying that they're not seeing any red flashing signals, that the market, there's a problem. They don't see any indicators of financial stability risks. And again, the Fed is never going to let you know if there is, because people will panic, and their job is to hide that from everyone so they can bring down the economy and steal your wealth. They don't want people to know what's really going on. Remember, they're not part of the government. They're a separate corporation. They make a profit. All their information is hidden from the public, and they're running our country, our economic policies of this country. Anyone see a problem with this? Yes, there is a major problem with this. But on December 5th, the OFR released its annual report for 2017, and it contradicts everything that Yellen has said. And the report noted that there are numerous areas where literally flashing red and orange signals are going off everywhere, and the market risk is in the red zone. The report notes the following: market risks from a sharp change in the prices of assets in financial markets are high and rising. Rising prices and falling risk premiums may leave some markets vulnerable to big changes. Risk premiums are returns in excess of returns on risk-free investments. Such market corrections can trigger financial instability when the assets are held by entities that have excessive leverage and rely on short-term debt and other liabilities. So going forward, what is happening here is the Fed is trying to make it seem like everything is fine. And what we're really seeing is that we have financial instability all around us, and we're seeing red, orange signals flashing everywhere. And I just wanted to mention one other thing about retail. We also need to keep in mind that the debt is coming due in 2018. So a lot of these retailers are going to have to pay up. And with this 4.9% debt, where people are spending debt, this is not money they actually have, this is going to be a problem, because once we get the real information from the retailers, and we find out what sales they have, what their revenue is, what profits they made, and how much they owe on this debt, well, we're going to see a lot of problems happening. Now, we understand the crypto market continually surges up. It dropped a little bit and keeps moving up. And like I said before, the crypto market is incredible. It's a decentralized system in the hands of the people. It's an incredible system. Same thing with gold and silver. In the hands of the people, keeping everything on the up and up, just like with cryptocurrency. It is an incredible system. It's when the central bankers get involved. That's when everything breaks down, because they don't like gold and silver. They don't like a decentralized system where the people can control everything. And what they're pushing for is their own type of coin in the crypto market, because they see what the crypto market is. Now, the Washington Post was pushing a piece about the Fed coin. They're saying it doesn't exist yet, but I think it's waiting in the wings. But one thing that we do know that does exist already, and we talked about this before, where UBS, BNY Mellon, Deutsche Bank, Santander, and many other banks, they've been working on their own crypto coin. And this crypto coin is called Utility Settlement Coin. Sounds very familiar. And I mean, it sounds like a familiar name, I should say. And this is real. They've been developing this for quite a while right now. And the banks have been testing this. Now, the ultimate goal of this project is to create a digital currency known as Utility Settlement Coin, which will facilitate payment and settlement for institutional and financial markets. This is what the official Deutsche Bank website says about utility settlement coin. USC is an asset-backed digital cash instrument implemented on distributed ledger technology for use within global institutional financial markets. USC is a series of cash assets which with a version for each of the major currencies, the dollar, the euro, and many others. And USC is convertible at parity with a bank deposit in the corresponding currency. USC is fully backed by cash assets held at a central bank. Spending a USC will be spending its paired real-world currency. UBS and Clearbatics launched the concept in 2015 to validate the potential benefits of USC for capital efficiency, settlement, and systemic risk reduction in global financial markets. The project was initially incubated as part of UBS Crypto 2.0 Pathfinder program, UBS's initiative for research and experimentation on blockchain. Now, they're going to be pushing this out because they're almost done testing it, and they're going to be trying to position themselves to enter the blockchain system with the USC. And I think what they're going to try to do is they're going to try to transition everyone into this. Now, is everyone going to go willingly and say, well, let's go to the central banks, let's use their system? No, of course not. They're going to stick with Bitcoin, Bitcash, Dash, Litecoin, and any other cryptocurrency out there. Now, the problem is if the central banks push the government, not just the United States, but other governments, into creating laws. This is how the central banks infiltrated our system in the first place. They had Congress pass laws. They had each state vote on it, and they said, yes, all the states agreed, and the central bank was born in 1913. Because without that, nobody was going to use the Federal Reserve note. Nobody really cared about it. The same thing here. If they get Congress, and this is created into and made into law, not just here in the United States, but in other countries, everyone will have to use this. Yes, you probably could still use Bitcoin. You can still, unless they decide to get rid of them. And I think this is why we're seeing this surge in Bitcoin and a lot of these cryptocurrencies, because this is how the central bankers play. They like to pump this up, and they can buy a lot of this with free money and then drop it and say, hey, this is volatile. It's not safe. Look what we have. We have the USC. And it just so happens we're pushing the government to make this law, that this is what you have to use, because those other cryptocurrencies, they're very dangerous. And this is why they've been manipulating gold and silver for a long time with paper contracts. This is why they set up a futures contract for Bitcoin, because they're trying to control it all and shift everyone away into their new system. And I do believe their new system is going to be made up of many different things. I think at a high level, countries will be trading maybe the petro yuan and using that. And at a lower level, they're going to want everyone to use the cryptocurrency, because this will be a cashless society, but they want everyone to use theirs. And I think this is what they're going to try to push for. I think this is what they're trying to position themselves in the blockchain technology. I think they're trying to transition everyone into this, and I think this is the play they're going to try to make. And I'm not saying that cryptocurrencies is bad. I like cryptocurrency. I think it's a fantastic thing. The problem is when central bankers get involved. I love gold and silver. The problem is when central bankers get involved. If we remove central bankers, these two systems are fantastic. Actually, any system would be fantastic without the central banks. So you can see right now we are headed into a period of time when everything is transitioning. The economy, I know they're telling us the economy is doing great. It really isn't. Nothing has changed since Trump came into office. Yes, he's done many different things, but the economy was always dying. You can't just flip a switch and all of a sudden the economy, starts to happen. We have $20 trillion worth of debt. Most of the people don't have full paying jobs. A lot of the retailers have been laying off thousands upon thousands of people. And once again, we can see all the numbers have been manipulated. Unemployment, GDP, you name it, they manipulate it. So what we're seeing here is this attempt to make it look like everything is fantastic. And this is what they've done in the past, because what they want you to see is that everything is great. The central bank has done their job. And of course, they want some type of an event, some type of distraction to bring the system down, transfer it over to someplace else, and then say we need to use our new system. And I think this is their play. I think this is what they're trying to do. They just can't figure out how they're going to do it at this point. But they will figure out a way. They will try. They will push their agenda, because they never give up, because they want control of everything. And that's the name of the game. It's not about, who's the wealthiest, because they can create currency out of thin air. It's who can you control? How many assets can you acquire? What countries can you can control? What armies can you control? This is the name of the game for the central bankers.